The most dangerous moments in financial history do not announce themselves. They arrive quietly, under familiar language. Stability, resilience, soft landings, temporary stress. The public is trained to look for collapse the way it appeared before as a sudden shock, a visible break, a single event that forces attention. That expectation is now obsolete. What is unfolding does not resemble 2008. Not in structure, not in sequence, not in consequence. In 2008, the system broke because leverage hid inside complexity. Risk was mispriced, misunderstood, and then suddenly revealed. This time, the risk is fully visible, and no one is pretending otherwise. That is the signal. What we are observing today is not a surprise failure. It is managed deterioration. Balance sheets are no longer opaque. Debt is no longer hidden. Losses are no longer theoretical. They are acknowledged and absorbed slowly, deliberately, politically. This is not a crisis of ignorance. It is a crisis of exhaustion. The mechanisms that once absorbed shock now transmit it. The institutions that once stabilized the system now anchor it in place, adding weight where flexibility once existed. The architecture has changed. Central banks no longer sit above the system. They are embedded within it. Largest buyers, largest holders, largest guarantors. Governments are no longer backstops. They are balance sheets under stress. Banks are no longer intermediaries of growth. They are warehouses of duration risk. And markets no longer price probability. They price intervention. This matters now because the margin for intervention is gone. Interest rates are not merely higher. They are structurally incompatible with the debt load they must service. Fiscal deficits are not cyclical. They are permanent. Liquidity is not absent. It is misdirected, locked inside instruments that cannot exit without destabilizing the whole. The public conversation remains theatrical. Elections, conflicts, headlines, emergency meetings. But the real story is quieter. It is written in refinancing schedules, in rollover ratios, in maturity walls, in sovereign auctions that barely clear. It is written in commercial real estate valuations that no longer connect to cash flow, but cannot reprice without triggering regulatory failure. It is written in China's balance sheet contraction not as a collapse, but as a withdrawal. It is written in capital flows that no longer chase return, but seek insulation. These are not coincidences. They are coordinated constraints. In 2008, the system failed because trust vanished overnight. In this cycle, trust is being rationed in advance. The assumption most people still carry is that a crisis must look dramatic to be dangerous. That is a comforting belief. But structural failures rarely explode first. They sink, slowly, heavily, under their own accumulated weight. By the time the surface reacts, the foundation is already compromised. The year 2026 matters not because of a prediction, but because of arithmetic. Debt does not negotiate. Interest does not pause. Demographics do not reverse on command. And political timelines do not align with financial ones. The question is no longer whether stress exists. It is where it is being stored. This investigation is not about forecasting a date. It is about identifying the final load-bearing structures and watching how they bend. Because when a system fails quietly, the warning is not panic. It is normalization. What follows is not a headline narrative. It is a structural one. And the data tells a story far heavier than the language used to describe it. What the data says start with the debt, because everything else is downstream. Global debt has not merely increased since 2008. It has changed character. In the aftermath of the financial crisis, debt growth outpaced economic growth at nearly a 2-to-1 ratio. That alone is destabilizing. But more important is where the debt accumulated and how it must now be serviced. Sovereign debt is no longer countercyclical. It is structural. Governments did not borrow to bridge recessions. They borrowed to replace growth. Primary deficits became normalized. Temporary stimulus became baseline expenditure. At the same time, interest rates remained artificially suppressed, disguising the true cost of this expansion. That suppression has now reversed. Interest expense is accelerating faster than GDP, faster than tax revenue, and in many cases faster than defense spending. This is not theoretical stress. It is mechanical. Every refinancing cycle increases the effective interest burden. Every rollover pulls future stability into the present. The data shows this clearly. Maturity walls between 2025 and 2028 are historically large across sovereigns, banks, and corporations simultaneously. That simultaneity matters. In 2008, stress was concentrated. Today it is synchronized. Why this behavior is abnormal in a normal cycle? Rising rates slow borrowing and cool inflation. That mechanism no longer functions. Governments cannot reduce issuance without triggering contraction. Central banks cannot cut aggressively without reigniting currency pressure and inflation risk. Banks cannot absorb duration losses without eroding capital. Markets cannot reprice assets honestly without destabilizing the institutions holding them. This is not a policy failure. It is a structural bind. The abnormality is not that debt is high. It is that no actor can move without harming the system they are meant to protect. When every lever breaks something, intervention becomes delay. Delay becomes policy. Strategic interpretation viewed through a strategic lens. Current policy decisions reveal intent, not optimism. Rate pauses without cuts. Liquidity facilities without expansion. Regulatory forbearance without resolution. These are not signs of confidence. They are signs of containment. Authorities are not trying to restart growth. They are trying to slow degradation. This is crisis management without the language of crisis. The objective is not recovery. It is time. Who is absorbing the pressure? The pressure is being distributed downward. Banks absorb duration risk. Pension funds absorb volatility. Households absorb inflation through reduced purchasing power. Commercial real estate absorbs valuation collapse quietly through extensions, pretend and extend refinancing, and accounting flexibility. Losses are real. Recognition is delayed. This is how systems fail without triggering alarms. Where the money and resources are going, capital is not disappearing. It is retreating. Short duration, hard collateral, strategic commodities, energy infrastructure, defense-linked supply chains. This is not speculation. It is reallocation toward survivability, not growth. Liquidity follows perceived durability. Why this weakens one side and strengthens another? Highly financialized economies depend on confidence and leverage. Resource-backed systems depend on control and flow. As financial claims multiply faster than real output, the system favors those who control inputs, not abstractions. This is not ideological. It is mechanical. The imbalance widens quietly until adjustment becomes unavoidable. The most persistent misunderstanding about systemic failure is the belief that it begins with collapse. It does not. It begins with adjustment that never quite finishes. What defines this moment, what separates it from every prior cycle, is not the presence of stress, but the absence of resolution. The system is no longer attempting to cleanse itself. It is attempting to persist in an altered state indefinitely. That is not stability. It is suspension. In previous eras, crises were violent because the system still had elasticity. Excess could be purged. Assets could reprise. Institutions could fail without threatening the entire structure. Today, elasticity has been engineered out. Every major pillar, sovereign debt, central banking, commercial credit, global trade, energy flows, has been interconnected deliberately, so that failure in one transmits immediately to the rest. This was not accidental. It was designed to prevent panic. But designs that prevent panic also prevent correction. What has quietly shifted beneath the visible system is the definition of risk itself. Risk is no longer something to be priced and distributed. It is something to be contained and delayed. Losses are not denied. They are deferred. Volatility is not eliminated. It is redirected. This is why traditional models no longer apply. Economic forecasting assumes cycles. Cycles assume recovery. Recovery assumes growth. But growth is no longer the stabilizing force it once was. Demographic expansion has slowed or reversed across the developed world. Productivity gains are uneven and capital-intensive. Debt growth has substituted for income growth for more than a decade. The future has been pulled forward and spent. In this environment, the concept of a safe haven becomes conditional. Sovereign bonds were once safe because states had fiscal flexibility. That flexibility is now constrained by interest expense that compounds faster than political legitimacy. Equities were safe because earnings could grow faster than inflation. That assumption collapses when capital costs rise and demand weakens simultaneously. Real estate was safe because leverage could be refinanced cheaply. That logic breaks when refinancing itself becomes the risk. Even currencies, once anchors of stability, now depend on relative weakness elsewhere. Safety is no longer absolute. It is comparative. This is why insiders are not seeking protection in the traditional sense. They are seeking positioning. Positioning is not about predicting collapse. It is about recognizing constraint. The behaviors that signal this shift are subtle but consistent. Duration is being shortened, even at the cost of yield. Liquidity is being prioritized over return. Exposure to systems dependent on continuous refinancing is being reduced. These are not emotional decisions. They are structural responses. The public narrative continues to frame the present as a temporary deviation from normal. Inflation will fall. Growth will resume. Policy will adjust. But systems do not revert to normal after structural transformation. They stabilize into something else. What we are living through is not the end of a cycle. It is the end of an assumption that debt can expand faster than real output without consequence, indefinitely. The consequence is not immediate collapse. It is loss of maneuverability. Every future shock now matters more because there is less room to absorb it. Every intervention carries higher secondary costs. Every delay increases eventual adjustment. This is why current stability must be understood as artificial, not false, but conditional. It depends on continued confidence in mechanisms that no longer solve problems, only postpone them. It depends on political cohesion in societies experiencing economic compression. It depends on global coordination in a world moving toward fragmentation. It depends on trust in institutions that are increasingly forced to choose between transparency and control. These dependencies are fragile. Systems fail quietly when the cost of honesty exceeds the cost of delay. And then, when delay becomes impossible, failure accelerates. The coming shift, whenever it fully manifests, will not arrive as a single event. It will arrive as a phase change. Markets will still function. Governments will still issue debt. Banks will still operate. But the terms will change. Liquidity will become selective. Credit will become conditional. Access will replace abundance. This is how complex systems downshift. The most important signals going forward will not be headlines or crises. They will be procedural changes. Rules adjusted quietly. Facilities expanded discreetly. Definitions altered subtly. When authorities stop explaining why and begin explaining how, the transition is already underway. None of this requires panic to be true. It requires only arithmetic, time, and gravity. The weight of accumulated obligations does not disappear because it is inconvenient. It redistributes stress until something gives. And when that happens, the system will not ask for permission to change. It will simply do so. This is not a call to fear the future. It is a recognition that the future is already being shaped, incrementally, quietly, and without ceremony. The final mistake would be expecting a dramatic signal. There will be none. Only the slow confirmation that the rules everyone relied on no longer apply. And by the time that becomes obvious, the adjustment will already be irreversible. Final line. The structure is still standing, but it is no longer load-bearing.